Hi, I'm Matt Simpson. I'm the CEO and founder of Black Iron Inc. My background is I'm a chemical engineer with an MBA. I started my career with Hatch, which is a global engineering and consulting company where I used to design metallurgical refineries and then constructed them for a number of years in Australia before joining Rio Tinto, where I worked in their iron ore division in several roles, including the general manager of the mine at the Iron Ore Company of Canada, where I had over 650 reports and managed a spend of around 300 million a year. I think it's very topical to speak about an iron ore project at this particular time because one of the outcomes with COVID is that there's a massive amount of stimulus being spent by governments around the world due to the amount of unemployment and to try and help medium and small businesses stay solvent. And what we're seeing is that in countries such as China, and this is spreading to the rest of the world, that some of this economic stimulus is now being focused more towards building the economy and therefore infrastructure. And wherever there's a lot of spending on infrastructure, being the construction of roads, bridges, railways, 5G networks, it entails quite a bit of consumption of steel and therefore iron ore. And that's resulted in iron ore being the #1 performing commodity on a price basis year to date, even outpacing gold's run to 2000. So why should you consider black iron? Well, black iron is the top ranked undeveloped iron ore project in the world by both CRU and Wood MacKenzie, which are highly regarded market intelligence firms. And the reason why is that with iron ore, to be successful, it's all about moving large volumes of material at low cost. And to do that, proximity to railway, power lines, ports, and skilled labor is what makes or breaks your economics. And in black iron's case, the reason our economics are so exceptional is that the government-owned railway with surplus capacity is only 2 kilometers from our site. High voltage power lines run right beside that rail, which takes you to 5 ports between 230 and 430 kilometers from our site. And there's a city of 750,000 people where a skilled electrician, mechanic, or welder makes only 10,000 a year. To put that in perspective, when I used to work for Rio Tinto, I paid my frontline workers in excess of 120,000 a year, and that was 30% of our operating cost in Canada. And in black iron's case, you're paying a 12th of that, let alone what the rates are in Australia of upwards of 200,000. The other thing I think that's really exciting about black iron's project is we're making a 68% iron content pellet feed. That's in the top 4% globally. But more importantly, for the environmentally conscious investors, the higher the iron content, the lower the amount of emissions that are generated in making a ton of steel, which is essential for so many things in everyday life. So speaking about the market, as you can see, the forecast for pellet feed is that there's going to be about 130 million ton shortfall over the next 15 years, out of which about a third is going to be what's called direct reduction iron ore, which serves the Middle East markets, which are very, very close to black iron's project in Ukraine. And that's exactly the type of product that we're looking to make and service. In terms of our cost position, if you look on the bubble chart on the left, you can see Wood Mackenzie's ranking of all the different development iron ore projects in the world. And what you'll see is black iron's Chemnitsky project is ranked as having the highest after-tax internal rate of return and one of the highest iron ore contents. On the right is the bar chart of the global cost curve done by CRU. And you can see that we're not only first quartile, but black iron's Chemnitsky project is actually the lowest cost undeveloped project in the world. And again, it's because you're not building big infrastructure, and what you are building and operating with is using that local, highly skilled labor. Looking at our project site today, you can see that's kind of a rolling grass field. And if you squint towards the top of the picture here, you can actually see the high voltage power lines. And right beside those power lines is the railway. The reason why I emphasize that as being so important is that rail costs around 1 kilometer, $3 million, or about 5 million a mile, and power lines are about 2 million a kilometer. So very, very expensive to build this infrastructure. So if you're only, say, 500 kilometers away from where your water access is located, you can easily spend upwards of $1 billion just on infrastructure, and you haven't even touched building a mine yet. In terms of our project economics, we're fortunate that we're able to phase the construction of our project. So the plan is to start with an initial 4 million tons a year. It's going to cost us $450 million to do that. Our cost to mine, process, rail, and load an ocean-going vessel with 68% iron is $33 a ton. Using a very conservative long-term iron ore price of only $62, today the price is more than double that. And then making adjustments for our iron content and our low trace elements means that we should be able to realize a sale price of just under $100 a ton. If you put that into a cash flow model, that gives us an after-tax NPV with a 10% discount rate of 1.4 billion US and a 34% IRR. It generates about 300 million a year of free cash for the initial 17-year mine life, which is important not only to quickly service our debt, but also to self-fund an expansion from 4 to 8 million tons, which will cost an incremental 364 million. So people might ask, how does a company with a market cap of only 30 million Canadian ever expect to raise 450 million? And I think this is the most exciting part about Black Iron. When you take that 450 million and you first split it between equity and debt, and you use a 40-60 split, it means we need to raise about 180 million of equity and about 270 million of debt. Now on the equity side, the bulk of our financing is going to come from an offtake agreement. So what this means is we'll actually sell the rights to a steel mill or a global trading house like Glencore to purchase our initial 4 million tons of production at a discount to market of somewhere around 2 to 5%. If you realize that we're going to sell our product for at least $100 a ton, a 2 to 5% discount means $2 to $5 per ton on 4 million tons. So that's 8 million to 20 million for 17 years. So that means about 150 to 350 million of value, out of which we need 180 million. We also have heads of agreements in place with 2 construction companies, one of which will be selected to provide about 60 million of equity financing. And we're in advanced discussions with a prominent United States-based family office for $100 million royalty. So everything's nicely coming together to pull that equity in place without having to raise massive amounts on the traditional markets. On the debt side, Ukraine is a country that's very, very strategic for several European countries to bring it closer within their sphere and away from Russia's influence. So we at this time already do have expressions of interest for all of the debt required on this project, backed by export credit agency guarantees. And the timing is really around the corner. So one of the first things that could happen is either the royalty or the offtake on the project, and we expect that to happen very early in the new year. On the back of that, we expect to update our feasibility study, and in parallel to that feasibility study being updated, the banks that are looking to provide the debt will conduct their due diligence, such that we should be able to secure the debt financing late summer of next year to then start construction. During this time period, there's also some land that Black Iron requires that's owned by Ukraine's government that needs to be transferred. We not only have a memorandum of understanding in place with Ukraine's prime minister right now to transfer that land, but we also have the support directly from the president of Ukraine on his official website for this project. In terms of Ukraine as a country, Ukraine is now at peace and is focused on rebuilding its economy. Ukraine actually ranks by the World Bank far superior than most people would realize. It's 64 out of 190 countries in the world. So every year the World Bank puts out what they call their Ease of Doing Business Index, and Ukraine's ranking is well above every country in Latin America and every country in Africa. And that's attracting some major investors such as our next door neighbor, ArcelorMittal, who have an operating iron ore mine and steel mill that they're looking to modernize by putting 1.8 billion in. And this mine is within only 1 mile of our site. You also have Brookfield Asset Management, a predominant builder of major high-rise buildings, office towers, shopping malls, who are putting 160 million into Ukraine right now. So Ukraine, despite having a very high literacy rate, only has a GDP per capita of $3,100. And that's why you see such attractive labor rates for skilled people and why some of these major companies are coming to Ukraine. So in summary, why now? Why Black Iron? Well, again, with all this massive amount of economic stimulus going into infrastructure, in particular, there will be an announcement very soon in the United States of at least $1 trillion on infrastructure bills to help get people back to work. There's going to be a massive demand for iron ore, and Black Iron's project is the top-ranked undeveloped iron ore project globally. We have a solid plan to finance construction, which is going to unfold in the coming months, support of the president of the country, and extremely strong interest to get this project financed into construction, which will benefit shareholders. Thank you for listening. I hope to speak to you one-on-one at the conference.